Right now, yachts that would have sparked bidding wars 3 years ago are just sitting. Dealers are discounting new boats 20–30%. Banks are dumping nearly new wakeboats and motor yachts at auction. And at the very top of the market, governments are literally fire-selling seized superyachts for half of what they were worth on paper. So what happened? Why are yachts suddenly cheap? And why are prices still falling? In this video, we're going to unpack the great recalibration of the yacht market, how the COVID boom created a fake reality, what changed with interest rates, insurance, and inventory, which types of boats are getting crushed the hardest, and how repossessions and distressed sales are quietly resetting prices everywhere. And if you stick with me to the end, I'll give you a simple 4-step buyer's playbook you can use right now to spot genuine opportunities without getting wrecked by hidden costs. If you like honest, no BS breakdowns of the boating world, hit subscribe and tap the bell. It tells me to keep making these deep dives for you. All right, let's start with the big picture. The COVID sugar high and the hangover. From 2020 to 2022, the yacht market went completely off script. Travel shut down, work from home exploded, money was cheap, and suddenly let's buy a boat went from crazy idea to logical family plan. Dealers ran out of stock. People were wiring deposits on boats they had never seen, sometimes waiving surveys, sometimes paying 20, 30, even 40% more than pre-COVID prices. Anything that floated sold. Pontoons, wakeboats, center consoles, small cruisers, big cruisers, even tired old sailboats that had been baking in boatyards for years suddenly had buyers. At the same time, manufacturers were dealing with supply chain chaos. Engines were delayed, resin was delayed, electronics were delayed. So yards did what every industry did. They ramped up orders. Dealers double-ordered to make sure they got something to sell. Builders expanded capacity, hired workers, opened shifts. That's important because boat building has a long lead time. The boats dealers are trying to sell in 2024 and 2025 were spec'd, financed, and built based on the insane demand of 2021. Now fast forward. Travel is open again. Offices want people back. Groceries, rent, fuel, and mortgages are all more expensive. The COVID cohort of first-time owners has discovered that boats are not just a big purchase. They're a lifestyle and a constant bill. So they're trying to sell. At the exact same time that all those extra boats manufacturers built during the boom are finally hitting dealer lots. Demand down, supply up. That's the core of why prices are crashing. But there's another piece that really drives the knife in: the cost of money. The end of cheap capital. Most boats under, say, 50 feet are not paid for in cash. They're financed. During the boom, you could get a boat loan around 4% interest if your credit was decent. Monthly payments felt manageable, especially with stock portfolios up and real estate booming. Now, those same boat loans are coming back at 7, 8, 9% and higher. So imagine a $200,000 boat. At 4% over 15 years, the payment might land somewhere around $1,500 a month. Painful, but doable for a dual-income family that thinks they'll use the boat every weekend. At 8 or 9%, that payment jumps into the $2,000+ range. And that's before dockage, insurance, fuel, and maintenance. The same thing happens at every price tier. Super prime buyers with amazing credit see their payments jump 20 to 30%. Prime buyers with normal good credit see 35 to 40% increases. Subprime buyers, a lot of them are simply locked out. The banks either won't lend at all, or the rates are so high the math makes no sense. Now zoom out to the dealerships. Dealers don't just get stock for free. They borrow money against it on something called a floor plan. That's basically a giant credit line they use to buy boats from the manufacturer. While the boat sits on the lot, they're paying interest on that floor plan loan.
When interest was close to zero and boats were selling in days, nobody cared. Carrying costs were tiny. In 2025, with interest rates double or triple and boats taking an extra month or two to sell, those holding costs are brutal. So dealers are under pressure from both sides. Fewer people can qualify or are willing to finance a boat, and every extra week that boat sits there costs the dealer money. The only way to relieve that pressure is to discount hard, sell fast, and free up credit. That's why you're seeing non-current new boats, 2023 and 2024 models, being blown out at 20–30% off just to get them off the books. And once those new boat prices fall, every used boat above them has to fall even harder. If you can walk into a showroom and buy a brand new 2024 for 30% off, you're not paying 90% of retail for a 2-year-old model from a private seller. You're going to demand 40 or 50% off. That's exactly what we're seeing. From shortage to glut, the inventory flood. So demand is weaker, money is more expensive, and dealers are desperate to liquidate. Now layer in the inventory story. During the boom, dealers were placing huge orders because every boat they could get their hands on was selling instantly. Manufacturers expanded production based on that demand signal.
But because boats take time to build, the peak of production arrived after the peak of demand. By late 2023 and 2024, buyers had already started pulling back. But the pipeline was still full. Finished boats kept rolling off production lines and onto dealer lots into a softening market. Today, in a lot of segments, we're in outright oversupply. You see it if you walk a marina. Rows of unsold new pontoons, wakeboats, fishing boats, cabin cruisers, all with faded 2024 stickers and sales tags that keep getting marked down. This is the classic bullwhip effect. A small change in real consumer demand turned into a massive swing at the manufacturing level because everyone overreacted on the way up. Now the bullwhip is snapping back. Let's talk about where it's hitting the hardest. Segment 1. The wakeboat and towboat crash. If you want to see where the market got most insane, look at wakeboats. Before COVID, these were already expensive toys. But between 2020 and 2022, prices went stratospheric. A fully loaded Mastercraft, Nautique, Malibu, or similar could easily push $250,000 to $300,000 for a 23 to 26-foot boat. A lot of those boats were purchased by financing-heavy buyers, high incomes, maybe a home equity line, maybe a long boat loan. The logic was, we're home anyway, the kids can't travel, let's enjoy the lake. Now reality has landed. Those boats have giant monthly payments, high insurance, big storage costs in the off-season, and they drink fuel. With commuting back, kids' schedules back to normal, and money tighter, a huge number of those owners are trying to get out. Retail sales for new wakeboats have fallen sharply. And on the repossession side, auction lists are full of late-model towboats with bank names in the seller field. When you see 2021 and 2022 boats, still basically new, still under warranty, being sold by lenders for half of original sticker price, that rewrites the entire value curve. The next buyer looks at that auction result and thinks, why would I pay close to list when I know the bank just dumped the same boat for 50% less? That's what a popped bubble looks like. Segment 2. Pontoons and smaller aluminum runabouts. Next in line are pontoons and smaller aluminum boats, the classic family COVID boat. These were the entry point for thousands of first-time owners. Simple, stable, easy to use. They exploded in popularity during the pandemic because they were the cheapest way to socially distance on the water with kids and grandparents. Many of those buyers put tiny down payments on huge loans, 15 or even 20 years, at peak prices. Now reality has landed. Those boats have giant monthly payments, high insurance, big storage costs in the off-season, and they drink fuel. With commuting back, kids' schedules back to normal, and money tighter, a huge number of those owners are trying to get out. Retail sales for new pontoons have fallen sharply. And on the repossession side, auction lists are full of late-model towboats with bank names in the seller field. When you see 2021 and 2022 boats, still basically new, still under warranty, being sold by lenders for half of original sticker price,
That rewrites the entire value curve. If you bought a pontoon for $80,000, borrowed nearly all of it, and that boat is now worth $55,000 in today's market, you can't just sell it to get out. You'd have to bring 20 or 30 grand in cash to closing to pay off the bank. A lot of people can't or won't, so they let the bank take it. That's why you see 1 or 2-year-old pontoons in repossession auctions next to towboats. Again, every one of those sales pushes market values lower for everyone else. Segment 3. Mid-market cruisers and motor yachts. The same forces are hammering cabin cruisers and motor yachts in the 35 to 70-foot range. This is the classic aspiration category: express cruisers, flybridge boats, Euro-style motor yachts. In the boom, these sold to entrepreneurs, executives, and upgraders who moved out of smaller bow riders and cruisers. They bought with the expectation that yachting would be their new lifestyle and that the strong economy would continue to fund it. They've now run into 3 big walls. First, the same interest rate shock. A $500,000 boat at 3 or 4% interest is lifestyle stretching. At 8 or 9% plus higher fuel and dockage, it's a financial anchor. Second, the operational cost squeeze. Marinas are raising rates, diesel is not cheap, and maintenance and refit costs have exploded with inflation. Third, many of these boats require professional help to run. Once you cross into the 50 to 70-foot range, insurers and ports often want to see a licensed captain. That means crew salaries on top of everything else. So you're seeing 50 to 70-footers show up in distressed inventory too. Bank-owned Sunseekers, azimuths, large American cruisers. Not junk, nice boats, relatively modern, but owned by people whose financial plan assumed the low-rate, low-inflation world of 2021 would last forever. It didn't. Segment 4. Superyachts and geopolitics. You might think the ultra-rich are immune to all this. To some degree, that's true. But even the superyacht world is feeling the recalibration. 2 big forces are at work here. First, sanctions. Russian ultra-wealthy buyers used to be a huge part of the 60-meter-plus market. Post-Ukraine, a lot of those yachts were frozen, arrested, or effectively taken out of normal circulation. Governments stuck with seized yachts have to deal with crew salaries, fuel, dockage, legal risk. The easy solution? Sell them. And because the state just wants them gone, those forced sales often happen at deep discounts versus what brokers would have asked in a normal private sale. Think of an 80-meter yacht valued around $80 million selling closer to $40, or a 70-plus meter yacht going at auction for well under replacement cost. Those numbers set psychological anchor points. A buyer looking at another 80-meter will say, "Why should I pay $70 when that one just sold for $40? Second, the new build order book is no longer crazy. In 2021, some shipyards were booked out for years. Speculative buyers would order a yacht just to flip it on delivery. Now, with interest rates up and global growth wobbling, that flip game is dead. Yards still have work, especially the very top Northern European brands, but lower-tier builders and semi-custom yards are under pressure. On the brokerage side, listings are sitting longer. Price reductions in the 5 to 10% range on very large yachts translate to tens of millions of dollars in value, simply evaporating. It's a softer, slower crash than in the towboat world, but it's still a reset. Owners who want out quickly either accept lower offers or eat very large operating costs while they wait. The silent killer: operating costs. So far, we've talked about purchase and finance, but one of the biggest drivers pushing yachts onto the market is simply the rising cost of keeping them. Let's start with insurance. After several nasty hurricane seasons and a string of big marine claims, insurers have raised rates and tightened standards dramatically. If your boat lives in Florida, the Gulf, the Caribbean, anywhere that looks risky on a hurricane map, your premium hits are huge. In some areas, major carriers have simply pulled back or non-renewed whole categories of boats. On top of that, many insurers have introduced hard age limits, over 20 or 25 years for smaller boats, over 30 or 40 years for larger ones. Coverage goes from expensive but doable to liability only if you're lucky. But here's the catch. Banks require full hull coverage to write or maintain a loan. Marinas often require proof of insurance even just for a slip or mooring. So a boat that becomes uninsurable is, in practical terms, unsellable to the average financed buyer. It's not that the hull suddenly got worse. It's that the financial plumbing around it shut off. That destroys resale value overnight. Now add crew. In the superyacht and larger motor yacht world, crew salaries have climbed sharply. There's a limited pool of qualified captains, engineers, and stews, and more yachts competing for them. Monthly payroll for a 40-meter yacht crew can easily rival a nice house's mortgage payment all by itself. Finally, maintenance and refit inflation. Parts are more expensive. Yard labor is more expensive. Supply chain delays mean boats sit half disassembled on the hard while invoices roll in. Simple annual services cost 20, 30, even 40% more than they did 3 or 4 years ago.
Put all that together, and many owners have arrived at the same uncomfortable conclusion. I like this boat, but it's not worth what it costs me every year to keep it. And when enough people reach that point at once, a wave of for sale signs hits the docks. The repossession and auction wave. Some owners can sell before the math gets too ugly. Others can't. When a boat's market value drops faster than the loan balance is paid down, you end up with negative equity. If you get sick of paying where your income drops or your business hits a rough patch, you're stuck. If you try to sell, and the best offer is $50,000 less than what you owe the bank, you either find $50,000 cash or you walk. That's where repossessions and voluntary surrenders come in. Lenders don't want to be in the boat business, but they hate non-performing loans more. So they take the boat back, hand it to a liquidator or auction house, and clear it fast at whatever the wholesale market will bear. To you and me, those auction results might just look like good deals. To the rest of the market, they are price benchmarks. If a like-new 2-year-old towboat sells at auction for $100,000, that's now the real value. The dealer up the road is not getting $200 for the same boat. The private seller with an optimistic listing at $180? Good luck. This is how distress in a relatively small part of the market, the repo yard, drags down values everywhere. Regional pressure points. This recalibration is global, but it's not evenly distributed. North America, and especially Florida, is the epicenter. Financing-heavy culture plus aggressive interest rate hikes plus a brutal insurance environment equals fast price moves. You see it in the volume of listings, in the size of discounts, and in the number of price-reduced tags on brokerage sites. On the U.S. West Coast and in the Northeast, environmental rules, limited slip supply, and high costs of living make ownership expensive even in good times. In a downturn, that pushes marginal owners to sell quickly rather than hold on. Europe is softer but similar. Economic worries in Germany, higher energy costs, and the loss of Russian buyers for big med yachts all weigh on prices. Operational costs there, VAT, marina fees, refits, are not exactly low either. One interesting twist is charter. As the cost and complexity of owning climbs, more people are deciding to charter instead of buy. That supports the value of boats that are commercial-ready, lots of cabins, built to code, good charter reputations, and hurts the value of yachts that are expensive to run but don't generate income. Over time, we're likely to see a clearer split between private toys and commercial assets, with very different value trajectories.
So, is this a crash or just a reset? In some ways, what we're seeing is simply reality reasserting itself. For about 3 years, boats behaved like speculative assets. People bought them expecting to sell later for as much or more. In some cases, they actually did. You could order a boat, wait for delivery, and flip it for a profit because somebody was willing to pay anything to get one right now. That was never sustainable. Historically, boats are depreciating assets. You buy them because you value the time and the experience, not because you think you'll make money. The crash feeling comes from moving from that fantasy back to normal depreciation very quickly, and from doing it in a world where the ongoing costs of ownership are shooting higher at the same time. So, what do you do with all this as a buyer? Let's finish with the promised playbook, a 4-step buyer's playbook for the crash. If you want to take advantage of this reset without getting crushed, here are 4 rules. Rule 1. Buy the whole cost, not just the price. The sticker or asking price is the down payment on the lifestyle, not the total. Before you get excited about a big discount, write down annual slip or storage cost where you live, realistic insurance premiums for that size and age, fuel at the hours you'll actually use, basic annual maintenance, and a refit allowance. If that yearly number doesn't fit your life comfortably, walk away, even if the boat itself looks like a screaming bargain. Rule 2. Check the 3 financial choke points: insurance, financing, and mortgage before you fall in love. Call an insurer and ask whether they will write full coverage on the year, make, and size you're looking at in your region. If the answer is no or liability only, that boat is cheap for a reason. Talk to your lender before you shop so you know how much the payment changes at different rates and terms. And make sure you actually have somewhere to put the boat. In many areas, slips are scarce. There's no point buying a 50-footer if you can't find a berth for it. Rule 3. Respect the distress market. Before you commit, look at repossession and auction results for similar boats. That tells you the real wholesale floor. If a bank just sold a 3-year-old example of the boat you want for $100,000 at auction, paying $180,000 in a private sale is generous. You might still choose to pay more for a better-kept boat with full records, but at least you'll know where the bottom truly is. Rule 4. Prefer simple, liquid boats over complex, niche toys. In a tough market, versatility holds value.
A well-kept center console, a simple express cruiser, a solid cruising boat, or a yacht that charters well is easier to resell than a hyper-specialized towboat or a very complex 60-footer loaded with finicky systems. If you're not sure how long you'll want to own, pick a boat that appeals to the broadest possible next buyer. Wrapping up, yachts are suddenly cheap, not because boating is dying, but because the fantasy economics of the pandemic years have collided with the reality of higher interest rates, higher running costs, and a huge oversupply of boats. For sellers, this is painful. For buyers, with cash, patience, and a clear head, it's a generational opportunity, if you focus on total cost of ownership and avoid the traps: uninsurable hulls, negative equity toys, and boats that only made sense in a world of free money. If you found this useful, hit subscribe and turn on notifications so you don't miss the next deep dive. I'll keep trading hype for honest analysis and hopefully help you make smart moves on the water instead of expensive mistakes.